Hi, everyone. This is Jason Burak of Wall Street from Main Street.
And this is Lee Justo from Risk.
Welcome back to another episode of Finance Unspun. This is episode number 7, Lee.
They've gone by quickly, and each one has been more interesting than the next.
And there's so many funny and crazy things to talk about. Welcome to Dystopia. We're not doing a Welcome to Dystopia show, but this episode might feel like it because of all the economic propaganda. And honestly, Lee, here in the United States, I'm right outside of DC in the DC metro area, about 20 minutes outside of DC in Northern Virginia. It really feels, and I interviewed, if my listeners want to get a feel for how messed up the economic data was in the Soviet Union, go back into the archives of my YouTube channel and listen to the interview I did with Austrian school economist Yuri Maltsev. If you do not know him, he was one of the top PhD economists in the Soviet Union economics department or economic propaganda department before he defected to the United States decades ago. And just hearing him talk about all the different sets of books the Soviet Union had, all the different lies, manipulations, top secret security clearance levels for the phony economic data, for GDP inflation. They wanted to fool everyone. It was all lies. He basically said there was no economy, there was no growth, there was no economy. And it really feels like things have just gone to another level, Lee, of just gaslighting, of economic propaganda, that the United States, we're not quite at Chinese Communist Party levels yet for economic propaganda. We're not
getting there quickly.
Yeah. We're not quite.
Here's a direct example. The CPI, according to the Bureau of Labor Statistics, ticked down 8.5% from July, from a 41-year high of 9.1% in June. Meanwhile, John Williams' Shadow Stats is he said the inflation figure is 16.8% in annual terms. And what he basically does is he calculates it the way they used to do it in the early 1980s. So it's just stupid. And everyone knows it because everyone buys stuff and they see the prices of everything going through the roof.
Well, the producer price index, and that's what the government measures, the Bureau of Labor Statistics and the US government economists measure for businesses, what they survey, that's saying like 17, 18% cost growth. So You have the changing propaganda index, or CPI, and that's nowhere near what John Williams, the Shadow Stat, says, and not even near what the producer's price index, the cost of goods sold, what it's for a small business owner, for corporations, all these different input costs are going bonkers. And we're going to start seeing, we haven't seen them yet, really. We're going to start seeing wage increases soon by mandatory wage increases by governments, politicians, bureaucrats, labor unions, to try to force wages higher as a selling point to buy votes, to get people to vote. So workers at minimum wage jobs or a little bit above that, for some type of inflation offset, even though it's not really going to offset inflation, because if your wages are only raised 3%, 5%, 6%, 7%, still nowhere near the real inflation rate. But I mean, the amount of economic propaganda, we're not quite, as I said earlier, we're not quite to Chinese Communist Party levels or so.
But Jason, what you mentioned before,
we're getting more and more Orwellian.
what you mentioned before about the tweets yesterday, that was hysterical. I think that was before we recorded. But
I don't know if she has deleted the tweets yet, but for our listeners who have not, there are screenshots. She may have deleted the tweets. It was absolutely ridiculous. You have the press secretary for Biden. I don't know if she believes it or not, because I mean, like, as soon as the TV cameras are off and she's out drinking and doing drugs and having sex parties with her friends, when she's not at work, what they try to tell people and sell people on, she literally said yesterday on Twitter, and we're recording this on Thursday, August 11th, 2022. She tweeted this out, the press secretary for Biden, the new press secretary, on Wednesday night, that there is no inflation. And then she went on 5 or 6 tweet rants, a bunch of them, saying all the different reasons why there was no inflation. It was just shocking that they were trying to sell people on this, when the consumer price index even says, okay, they're claiming it's trending down to 8.5, like you said. I mean, double the real number. John Williams, the Shadow Stats, were at 17%, really bad stagflation. And that's, not according to Ed Batowski's Chapwood Inflation Index. I'm sure it's even higher than that, but it's just ridiculous. I mean, the Orwellian, my points here on the Orwellian stuff, I was speaking with people who are not conspiracy theorists, right? Regular finance people last week on Friday, when the jobs report numbers came out, And I was having people tell me, these are regular people in finance, not libertarian, not small government people. These are regular Democrats, regular Republicans who are saying, WTF is going on here? This jobs number was totally fake. They were literally tweeting out and then telling me this stuff and going through it. And unfortunately, the trend here, and this has been going on for a while, and it's just getting worse. You're going to have like a month or two later with the jobs report number. These were seasonal adjustments, right? That increase the jobs. And a month or two later from now, you're going to have the real jobs number. It'll be revised downwards enormously. It might
always,
yep. Yeah, it might be zero, or it may even be negative. And the average person, even the average financial professional, is not going to know or care or pay attention to it. And especially these high frequency trading algorithms that are so easily fooled by government or Wall Street headlines. And they just they scan the headlines immediately, or inside information is leaked to them with the inflation numbers or the phony jobs report data. And then the high frequency trading algorithms and the hedge funds just trade on that to move markets up or down.
Yeah. Well, the reality is that it didn't work in the Soviet Union, and it's not going to work here. I mean, people go out to the store, they buy their food, they buy their clothes, their school supplies, everything else. They know the prices have just gone kind of astronomically higher than they were a year or two ago. You just can't fool people.
Lee, do you mean you don't think that the Inflation Reduction Act that Congress just desperately passed, you don't think that that's going to actually work and actually reduce inflation?
I was thinking a lot about this a couple hours ago, and the central theme that just kept coming back into my head was central planners. Their solution is always to exert more control over things. And I think that like the whole Fed coin, central bank digital currency, it's all along that theme. They're losing control, so all they can think to solve the problem is to try and control things more. And it always fails.
So the Inflation Reduction Act, for our listeners who are not familiar, the way things work in DC now, and really this has been the trend since the Patriot Act, because the Patriot Act didn't promote freedom.
No, definitely not.
They put an Orwellian misnomer, so an incredible gaslighting or Orwellian name on a bill. And normally the bill has nothing to do with what the bill claims it does. And then even if there's a few things that might have anything to do with the bill, there's tons of special interest groups, pork log rolling. And the way things work here in the DC metro area is the more that Congress can spend, the more that can be stolen by the people here in the DC metro area, politicians, bureaucrats, lobbyists, special interest groups, corporations, unbid government contracts through bribes, revolving door of corruption, or siphoned off. And so this is why you have spending increases. And because the United States has the dollar as a world reserve currency, military industrial complex here, welfare warfare state, the empire, we can get away with this for a lot longer than any other country. But there are limits to this. We'll talk about the limits in a couple minutes. A couple more things here on the economic propaganda, the fake Fed balance sheet. I was telling you, Lee, about the Occupy Feds on Twitter. They're going through every week. They're showing the data. It doesn't match. So tens of billions of dollars per week now, Lee. The Fed is still buying mortgage-backed securities. The Fed is still buying different types of bonds and treasuries. You have Fed insiders, former Fed insiders like Danielle DiMartino Booth and New York Fed trader Joseph Wang, who called me a liar back in February, March. He literally called me a liar, and it was retweeted like over 100 times, saying that the Fed's balance sheet will drastically reduce in May or June. All these things. The Fed's just reinvesting. It's drastically reducing. No. The Fed's official balance sheet claims it's going down. Meanwhile, tens of billions of dollars per week is going off balance sheet in toxic mortgage-backed securities, U.S. Treasuries. I think that the Fed actually, Lee, had to buy about $30 billion just this week in U.S. Treasuries.
Yeah, just before we move on to this, I just wanted to mention one thing about the Inflation Reduction Act and ask you a theoretical question. What the heck is putting $80 billion in and beefing up the IRS? What is the IRS going to do to reduce inflation? I don't get it. I mean,
the government is worried if asset prices stay low, they need to pick up every single penny from the little guy who can't afford lawyers, who can't fight who can't sue the IRS or fight the tax man.
or have offshore accounts and the like.
Yeah, so it's easier to go after the little guy who doesn't have an army of tax attorneys and tax accountants and CPAs on standby.
Yeah, no doubt about it.
The last point there on economic propaganda, though, last couple of weeks, I mean, I speak to oil fund managers, as you guys know, hedge fund guys. I've interviewed a lot of them the last 6 months, and I have a contact list, more of them. I'm working on getting more interviews. I actually had quite a few interview cancellations this week. Unfortunately, it happens when you're sending out a bunch of emails and big name guests, and people forget things in their schedule. Their assistant was supposed to put it down. Who knows the exact reasons? Anyway, though, I was hearing for weeks now that the Energy Information Agency, which here in the United States is an arm of the U.S. Department of Energy, that the gasoline demand data, it sounds like the Biden administration ordered that to show that the gasoline demand data here in the United States collapsed by over a million gallons. So that
which actually coincidentally happened during the highest seasonal time for using gas. I mean, people go away on vacation, and the summertime is always the highest. So I don't know how that happened.
Well, maybe Hunter Biden was able to get that oil from the Strategic Petroleum Reserve still being sold cheaper. He's able to get those maybe probably more than 6 million barrels, sell it to the Chinese. Because I mean, the hookers here in the DC metro area, drugs here in the DC metro area, he has some very expensive addictions.
I wonder what the inflation rate is on those items.
I don't want to guess. And it sounds like he parties like that basically every night. So he's blowing insane amounts of money, and he's gotten the Biden crime family, the Clinton crime family, the Bush crime family, both political parties, the McCains with the military industrial complex, Mitch McConnell. I mean, all these guys, both political parties, just insane. The longer you're here in Congress, as a general rule, except for Dr. Ron Paul, the longer you're here in Congress, the more corrupt you are, the wealthier you are,
no doubt,
from waste, fraud, corruption, and abuse. And then also, it's been coming out, this has come out more than in the past, although Peter Schweitzer, that was the author's name that I wanted to talk about in the last show. He wrote a book in 2011 about all the stock trades on inside information and real estate land deals and other perks that Congress was doing to get rich quick or get richer. Now people are finally starting to hear the truth about Nancy Pelosi and her husband. And it's not just them, although they are the biggest fish here that are doing that, but it's definitely not just them.
Oh, no doubt about it. You mentioned the Fed owning, oh my goodness, real estate based
mortgage-backed securities.
Yeah, mortgage-backed securities. I couldn't think of the term in my head.
Well, the banks are still making them. So the banks actually have still been cranking these things out because they know the Fed will buy them.
Yeah. Well, the only question I have is the 30-year mortgage rate is creeping up. It's almost 5.25%. So what impact do you think that's going to have on the real estate market? And my understanding is that China has probably the largest real estate bubble in history. Where do you think all that's going?
China is having an enormous real estate bust, but the Chinese banking system and their financial system is closed. They have very strict capital control for people inside China, the affluent inside China, to try to get their savings and wealth out. And for our listeners out there, a lot of affluent people in China, whether you're in the Chinese government, a high-level Chinese Communist Party official, you're a mayor in a tier 1 city, you're a high-level bureaucrat, you're high up in the military. A lot of these people, from my sources over the years talking, and I know people who know these people, they do not trust Chinese banks. So for years, they've been paying very high money laundering fees to get a lot of their savings into other currencies, into dollars, into euros, into other currencies in order to buy foreign stocks and foreign real estate. But the problem now is that the Chinese real estate market, there was the similar belief to the US real estate bubble up until 2007, 2008, 2009. The view was very similar in China that real estate prices never go down, that they only go up. And a lot of experts, whether it was Hugh Hendry, the hedge fund manager, Jim Chanos, Kyle Bass, others, they were predicting the Chinese real estate bubble was going to collapse, I think, 2009, 10, or 11. To prevent that, the Chinese government went on an absolutely insane infrastructure and spending spree. It was a fixed asset infrastructure plan. They spent around, I believe, 50% of their GDP, trillions of dollars, in just direct spending. And then that's in addition, the banks then, in addition to the direct spending plans, the banks were given a bunch of capital, and the banks started leveraging that up with additional loans. So you had the Chinese banking system, and I did a video on this in 2019 when the Chinese banking system started getting in trouble. I showed a bunch of charts and graphs. The amount of credit in China went from only about $1 trillion or $2 trillion in 2007 up to around 50 trillion by 2019. So unprecedented credit growth. A lot of it is tied to real estate. Real estate is the main source of collateral inside the Chinese banking system, and also, which is trillions of dollars in debt, trillions of dollars in credit, but also in their enormous shadow banking system. The main source of collateral for all those loans was based on the premise that real estate prices would stay high and would not go down. So the Chinese government, to save their banks now, and because they have a closed system, they've been printing trillions upon trillions and then changing all the banking rules to try to prevent their Chinese state-owned enterprise banks, their 4 or 5 largest banks, from going insolvent or looking insolvent, and then counterparty risk, very similar to the US. The main difference between the US banks, the European banks in 2008, 2009, and the Chinese banks is they don't have those extra tens of trillions of dollars in extra derivatives. Mm-hmm. But there's a lot of similarities there, because the assumption for a very, very long time, 15, 20 years in China, was that real estate prices would never go down. Now you have really bad stagflation in the real economy in China. You have much higher energy, electricity, labor costs for factory owners manufacturing in China of the cheap goods. And then you have now falling real estate prices in China, and the government, to offset this, is doing whatever they can, printing money to try to save the banks and changing all the reserve requirement ratios. Probably will change the accounting to save their banks.
My understanding is that people in China basically moved out of the countryside to acquire real estate in the cities. They borrowed money from their friends and families to do this, and it's just been a crazy frenzy of buying real estate. Some people just bought it for investment with that notion that they thought it would always go up, which to me is very reminiscent of 2007, 2008.
The affluent, so the upper middle class to affluent in China, some of them owned many, many pieces of real estate all over China, tier 1, tier 2 cities, and then also a lot of real estate in other countries. So their Chinese real estate holdings are down enormously. Some of them had mortgages, some of them did not. But what you're seeing now come out of the news stories for the last 6 weeks is that at least 1 million people have boycotted, stopped paying their mortgage in China because they're so upside down on their mortgage. But there is no strategic defaults, I believe, in China compared to the United States. So the bear thesis then, if you talk to commodities bears, is that demand is going to stay low, collapse because of deflation, because of central bank policy, because of a strong dollar, because China will totally collapse. China will stop building houses. China will stop consuming food. China will stop using energy. And so the commodities bull market we had for 2 years is over. That's according to the bear thesis for the deflationists, that the commodities bull market that we had up until the last 3, 4, or 5 months for over 2 years, which was the inflationary pressures, especially oil. So a couple of the main factors for all this stagflation, you have all the central banks and government, you have the stimmy checks, the central banks drastically expanding their balance sheet, but then you also have higher oil prices because oil and natural gas, electricity, they affect everything, especially food, transportation costs, manufacturing costs, all these things. So a higher oil price, a higher natural gas price is going to affect cost of goods sold and manufacturing costs. So that's the bear thesis. What the bears will not acknowledge is if you look at commodities producers, you look at what they're reporting on earnings. And by the way, oil and natural gas companies, even though the oil price has been knocked down substantially, oil and natural gas companies are still minting money. Free cash flow, really nice free cash flow, the best free cash flow growth, the best dividends, solid dividends, potential dividend growth are throughout the entire oil and natural gas complex, whether that's larger producers, pipeline companies, the refiners right now. I think the margins are still pretty good. So it's throughout the complex. Although the valuations for some of the companies like the refiners, those things are high, there's still really good value for some of these large, small, and medium oil and natural gas producers that are not pricing in high natural gas prices.
I assume they're certainly a much better investment in terms of free cash flow than the silver and gold miners are at this point.
The silver and gold mine, well, gold and silver are holding up. We're in terms of the order that we're going to go, and I think we wanted to talk about the limits for the other central banks that are not the Federal Reserve. So we didn't talk about this on the last show. I wanted to talk about this, and I forgot.
We're going to talk about New Zealand.
Yes, there was 2 or 3 weeks ago, the New Zealand Central Bank, or Reserve Bank of New Zealand, they actually issued a bill to the Treasury of New Zealand, and obviously the government can't pay the bill on their own. They have to probably go and tax the citizens, tax the businesses, small business owners. They told the government of New Zealand, look, our quantitative easing bond buying program, which is a fancy central banker speak or Orwellian speak, economic propaganda for debt monetization, for inflationary pressures, drastically growing the money supply in New Zealand to go and buy government bonds, fund the government. They went from under 10% ownership, the Central Bank of New Zealand, Reserve Bank of New Zealand, they went from under 10% ownership in, I think, 2018 or 2019, they owned about 9%, I think, of the government bonds. They went to 40%. So their quantitative easing bond buying program, there are limits. My point here is that there are limits for a lot of these other central banks other than the Federal Reserve Bank. They've hit the wall. So their currency exchange rate, problems in the government, inflationary pressures inside their own economy. They're not the world reserve currency. They don't have enormous amounts of they don't have enormous amounts of their own currency sloshing, tens of trillions of dollars sloshing around for global trade settlement.
I was going to say there's not global demand for the New Zealand dollar.
Correct. And, well, other than currency traders, correct. So,
right, of course.
So it's not being used to settle global trade. So as we talked about in other episodes, even though U.S. companies or the U.S. government might not be involved, the dollar is still the king, although it's trending downwards, is still the king for global trade settlement compared to any of these other currencies. Now, it's gone, I think, from around 70% 10 years ago, 70% of global trade settlement. I think it's 59% now. So the trend is down, but it's still the overwhelming majority.
Yes, no doubt about it. And, it's interesting. The Central Bank of New Zealand is carrying on with their 50 basis point rate hike this month. So,
and the Bank of England has raised interest rates too. The European Central Bank has raised interest rates. Yep. I mean, the Fed claims that they're going to do another 50 basis point hike at the September meeting, or 75. But the central bank, my point, another major point, the central bank accounting is not honest. None of these governments are being honest, because if the European Central Bank is raising interest rates, or they've raised interest rates once or twice, I don't remember the exact number, but are they disclosing that they're drawing on US dollar currency swap lines from the Federal Reserve Bank, and those dollars are being used to bail out German manufacturing companies, German investment banks like Deutsche Bank, Credit Suisse, the French investment banks? They don't have to disclose any of this. Okay, they don't have to disclose any of this unless
it's one big black box. It's one big black box.
Yeah, they don't have to disclose any of this unless they want us to, or unless there's a whistleblower who sends me an email.
Was that a hint there, Jason?
Well, actually, that's how I got the currency swap information back in 2014. So that's how I got the currency swap information that the European Central Bank, even though the Fed said the currency swap lines to the European Central Bank ended in 2010, I was getting information from someone at an IMF meeting in 2014 that the European Central Bank was still drawing trillions. Right. Dollar currency swap lines. So like all these crises that happen in Europe, in the European Union, whether it was Greece or the pigs countries or Brexit. So all these different crises every 2-3 years, especially Brexit, because you had all these big leveraged currency trades and derivatives trades on interest rates with all these large European investment banks and then their counterparties. I mean, these investment banks, to prevent them from collapsing, the European Central Bank was either buying bonds, corporate debt, or they were drawing trillions of dollars in currency swap lines, and they didn't want anyone knowing about it. And that's
central planners trying to manipulate things once again.
Well, Dr. Mark Faber, I interviewed him recently, but this interview, he mentioned this years ago. He was talking about just coordination. So to get us from 2008 through 2019, before the pandemic and before the repo crisis, I mean, there was a lot, trillions of dollars in additional inflation and hidden bailouts to prevent large investment banks like Deutsche Bank and others from collapsing?
I think we're at a wall again. I'm looking at the charts right now, and to me, it looks like the dollar is about to rally again. The equity markets are probably going to pull back here. I think gold and silver might either plateau or pull back a little bit. The markets are always shifting. I don't know how long those movements will be. Could just be a couple of weeks, could be a few months. Who knows?
Well, I think the good thing here for gold and silver, Lee, is that gold did not crash when the Fed announced that 75 basis point rate hike. So the gold price actually for the last couple of weeks, really since the rate hikes became public, the gold price has been on a nice rally.
Yeah, no, they definitely had a nice rally. I just think that it's going to pull back here, maybe pause the rally a bit. I see it continuing down the road. I'm extremely bullish on precious metals, just with all the currency instability. And then we see, countries like Russia and China, they're hoarding gold and silver now. I think they see the writing on the wall with global currencies. I think we see the writing on the wall with global currencies.
Well, also, Lee, to add to your points there, we've seen with the data coming out in the last couple of weeks, net central bank purchases are picking up again. So really the central bank tonnage increases for physical gold started picking up again in June and July. So we started to see an increase of buying the dip. So as the paper gold price was smashed in US dollars, central banks bought the dip. And then we saw enormous increase in Chinese demand, private sector Chinese demand through Hong Kong imports. I think it was over 200% increase in a single month over month. And then year over year, it was over a 300% increase in tonnage that was going into China.
Do you think these central banks are using a spoofer to get better pricing on there?
So actually the way it works, they can hire the average person doesn't understand this, that the bullion banks, the large investment banks that are market makers, the bullion banks, they actually get away with manipulation because if they're hired by a central bank to fill an order of gold tonnage, they can smash the paper price down and they get big commissions. So they can actually make a profit shorting the paper price. They can make a profit shorting it because they know they're knock it down. They fill the order of tonnage for physical gold, right? And then they get a larger commission from the central bank or the large buyer. So they can actually make multiple profits in multiple ways, depending upon who their customer is. So they actually benefit from the paper price manipulation. They can do this. The retail investor gets screwed. The mining companies get screwed. But the central banks get more physical gold tonnage. And I've been covering this since 2020. A lot of these other countries, they printed tons of their own currency, and then they would either buy dollars or buy physical gold.
Right, exactly. I think it's so funny, though, because for years, everyone was saying it was a conspiracy theory talking about the manipulation in the price of precious metals. And here we have recent verdicts handed down on some guys who were spoofing and actually doing that manipulation. So another conspiracy theory proven correct.
But unfortunately, it's just a slap on the wrist.
Oh, absolutely.
There's no disincentive to get the investment banks and the traders that work for them to get them to stop.
What do you think of this whole story with Andy Schectman? A $55 million purchase of bullion. That's a big deal. And
what was still cheap the last 3, 4, 5, 6 months? So are you willing to buy a lot of stocks that are still on a valuation basis, regular stocks? So regular NASDAQ, S&P stocks, other stocks that are still, their valuations are still high, but now their earnings, you're seeing employees fired. You're seeing they're drastically missing earnings. They're talking about inflation and costs. This is margin pressure. So what's cheap? What has more upside in an environment where I think there's still a lot more inflation? So even though these deflationistas are saying strong dollar, China's collapsing, if you look at what's cheap, if you look at the companies that are actually potentially beating earnings, that my main question as someone who tends to look for undervalued growth as a contrarian value investor where there's blood in the streets, like a Sir John Templeton type, where's the free cash flow growth? Which industries have the most free cash flow or the most free cash flow growth? And I would argue that it's not the companies like the big tech companies and the others that are firing loads of employees and talking about cost pressure and inflation. I would say it's the energy sector right now, oil and natural gas, and all the different companies attached to that that are looking really, really good here, because the market is very, very skeptical that oil prices can rally and go higher because of, they think gasoline demand is going to collapse. And then they don't think the natural gas price is sustainable, even though the U.S. is really, other than a few OPEC LNG exporters, you have Australia that's starting to ban liquefied natural gas exports, and they were a major exporter. So the Asian market is not going to get Australian liquefied natural gas that they were counting on, and emerging markets won't get it either. And then the only source of non-OPEC increase then for natural gas supply and liquefied natural gas is the United States. It's the only game in town. So we've seen stories that have come out in the last month or so that the U.S. is, other than OPEC, the main liquefied natural gas player now.
It's interesting you mentioned that, because you just have to wonder what other friction is going to occur between countries, and how these frictions will interfere in global trade and supply and demand. I mean, obviously the Ukraine's a big thing, but it seems like it's starting to spread a little bit. Countries are becoming more self-protective and less global focused, if you will.
Well, I did. Actually, I shouldn't talk about this because it's not going to be released publicly. It's only for George Gammon's very high level paying customers. But I said, like, a major theme here, after interviewing a lot of hedge fund managers, a lot of experts, the food and energy crisis, even though energy prices, oil prices at least, are down substantially in the last month or so. And we could argue whether or not that's manipulation. There's a lot of people that actually trust the government still. I don't know why, but they trust the government. They trust government. Yeah, there was one guy saying, like, you don't know capitalism or free markets, and that's why the oil price is down. Stop trying to blame it on something else. And it's like, yeah, the guy was saying it. I was like, do you believe everything the government says? And it's like, we just have more rules changes. We have blatant market manipulation now in so many different, and I'm using air quotes here because we don't even really have markets or price discovery. Maybe in the long term, in the long term we do. If there are supply problems and commodity prices go down, they're going to have to go higher in the next 2, 3, 4, 5 years, unless demand totally collapses. But I don't see that as permanent. So I think there is a long-term, and this is something that listeners can invest in. You don't go out and buy all your stock positions at once, but there is a long-term food and energy crisis here.
Oh, no doubt about it. No doubt about it.
So all these different countries, whether you're China, India, emerging markets, developed countries, they all need cheap electricity. Where's the electricity going to come from? The best meme I've seen recently was the 3 dragon heads, and one of them looks like it can't even see straight. And so you have natural gas, you have nuclear power. Those are the two safest plays for cheap electricity and power generation.
You mentioned food. China has actually just negotiated a deal with Brazil to buy corn from them. So, they're out looking. I don't think they can feed their population domestically from domestic production. So they need to find sources of food.
And Brazilian farmers, Lee, were not getting the fertilizer they needed to plant.
Yep.
So if they just got a contract to grow more food, to increase food production, they're going to have to go out, and they're going to have to buy fertilizer. I don't know if they're going to be able to buy it from Canada because Justin Trudeau doesn't want to sell it.
He's probably selling it on the black market with his cronies.
Yeah, he's hopping on his private jet. He's going to do some secret fertilizer deals.
Yeah, wouldn't surprise me. Nothing surprises me anymore.
But we live in just a crazy world now. It's totally dystopian, divorced from reality. Lots of manipulation and rules changes. The stuff going on in the stock market, Lee, is just absolutely insane. The average person, especially like these younger adults that have not been through a bear market before. I'm reading these social media posts about these people bragging about how they made 15 or 20% day trading in one stock position on a single day, how easy it is. Yeah, they're trading on margin. What they probably didn't say, they bragged about how they traded on margin only a week or so before they were getting margin calls. So So my point, though, is that like with the bear market, it's a roller coaster.
No doubt about it. Yep, no doubt about it.
You can't bet on a bottom necessarily, because we don't know what the central banks are going to. I mean, if the central banks can all pretend that they're going to raise interest rates and reduce their balance sheets, but they're secretly moving, or at least the Fed is secretly moving hundreds of billions of dollars per month or trillions of dollars or more per year, off balance sheet while they raise interest rates. I mean, the Fed's going to break the real estate market, going to break mortgage prices, going to break junk bonds. So there are limits to what the central banks can actually do with rules changes and manipulations. The market's going to eventually figure it out. You're starting to see people call the Fed's bluff now, Lee, in the bond market. When the Fed's saying they're going to raise interest rates, that's why you're seeing not only have you seen the Fed like create distortions on the yield curve, because I really believe, my educated guess is that the Fed thought that they could, if they bought more 10-year US treasuries, that would potentially cap mortgage rates. But now you're starting to see people in the bond market, as what Kevin Duffy said, the hedge fund manager, the bond market says, no, rates can't go higher. Yep. It'll collapse everything.
There's definitely a divergence between the Fed interest rates and what the market's doing, especially corporate bonds. So.
But the stock market, really, it is a roller coaster. We could see, and I was predicting this 6-8 months ago in articles for my patrons talking about this back in November. I was saying we could see 10, 20, maybe even 30% swings in a single day or two.
I really think that this fall is going to be very interesting in the market. I would not be surprised if we don't see something worse than like a 1987 crash.
Well, you also have so many day traders, and you have younger adults doing it.
It's just like the tech bubble, man. Just like it feels the same. Crypto felt the same. Well,
and I asked them if they've ever been through a bear market before. Have they studied a bear market? No, I don't want to read any financial history books. No, I don't want to listen to any of these old people that have ever been through a bear market before. They're boring. That takes too long. They're boring. I want to trade meme stocks and Coinbase on market.
Yep. Too much.
So the bear market swings here. The bear market rallies, the short covering, the Fed rate hikes, inflation numbers. We could just see incredibly violent swings. But the volatility is incredible. And yet I haven't looked at the VIX lately. Let me just pull it up. But the bond market volatility was absolutely insane. The VIX is down to 20, shockingly, despite the insane intraday within a couple day moves in a lot of different stocks. The VIX is down to 20. So they have a lot of people fooled, despite all this volatility, more volatilities in the U.S. Treasury yield curve.
Well, to me, I used to trade the VIX, and to me, it looks like we're like at topping because it kind of moves within a range, and that range changes as the volatility in the market goes up and down. But the volatility typically falls as we rally, and it falls the most as we're getting to the top of a rally, if you will. And it usually spikes when we're selling off. So I'm not surprised to see the VIX where it is. I think we're probably going to see it spike up over the next couple of weeks, as I think the markets are going to start selling off again.
Okay, Lee, as we wrap up here, one more question for you then. Do you think gold and silver are bottomed? And what's your opinion then on this gold and silver bull market potentially restarting?
I think we're at a point where I would look for the next pullback to buy. I wouldn't buy at this particular moment. I think there's a little downside risk here, but this is just short term. I think if you're a long-term investor, just buy gold and silver when you can.
And hopefully premiums will come down. Maybe we can get a really nice low premium bullion dealer to advertise on this new show that we have for Finance Unspun, episode number 7. But you're starting to see contrarian investments, mergers and acquisitions, counter-cyclical investments, the larger precious metal royalty and streaming companies. Just in the last 6 to 8 weeks, they've deployed billions of dollars in capital into either new deals for immediate free cash flow or into growth. So this is while people are saying mining companies, a lot of these mining companies don't have access to capital unless you're a low-cost mining company right now, because the majority of mining companies, if they have higher costs, bad balance sheet, they're a junior miner that's not potentially bring on a low-cost project, there is no capital available. Well, the royalty and streaming companies, they are deploying enormous amounts of capital right now as a contrarian investor, and it's paid off for them in previous bear market cycles in 2008, 2009, and in 2015, 2016, that 2, 3, 4, 5 years later, these companies, the amount of cash flows they've had, the free cash flow growth, the dividend growth, just enormous.
You really like those companies in the sector, and I think you're going to be proven right in the long run.
Well, I think so. The business model is far more efficient. They have way cheaper cost of capital. It's better than even owning a mining stock ETF. Once the royalty and streaming company gets to a certain level of scale with the amount of diversified assets in their portfolio, their profit margins are better. They can grow their dividends more efficiently than a regular mining company. And the free cash flow growth and dividends is just spectacular compared to, so like Sandstorm Gold just announced earnings today. Earnings came out today for Q2 for Sandstorm Gold. Guess what their costs were?
With the price of diesel fuel, I can only imagine.
Their costs were $273 an ounce. So they have margins over $1,500 an ounce.
Okay.
And they just started a dividend a couple quarters ago. So
nice.
So this is my point though, the underlying business doing superbly right now, while people worry about all these different mining companies. And Sandstorm Gold's a medium producer. They have a lot of growth that's already paid for. The larger companies are also doing big deals. There's rumors of even bigger deals, but they have inflation protection built into their business model, unlike a mining company. Now, if you time the miners right, if you time the cycle right, if you buy a low-cost producer when there's blood in the streets and the cycle turns, you can make easily 500% or more.
Oh, yeah, sure.
Yeah,
absolutely.
But if you mistime things, then you end up in a situation where the miners either potentially going bankrupt. If the bear market for metals prices or capital is not available for miners, the miner either goes bankrupt or the miner sells out to another miner, larger miner with a better balance sheet, more cash for pennies on the dollar. So then you don't get the upside. The larger mining company and those shareholders would get more of the upside. So the bankruptcy risk, the downside risk is way, way lower for the larger royalty and streaming companies. And there's also a non-precious metal. I just put out an article in the last couple of weeks, a non-precious metal commodity royalty company. They have royalties for potash, coal, base metals. That one's very, very interesting right now. The dividend's almost at 2%. They have really robust cash flows and they've been paying off a lot of debt the last couple of years. So that one's looking pretty good too. I might even go and buy that one for my own retirement account soon.
A little inside tip from you, Jason. That's good to hear.
Well, I didn't mention the company name. There's a longer article behind the paywall for my patrons. I mean, because I'm not going to make any money for Google AdWords revenues for the video, so I may as well promote my Patreon a little bit.
Sure, no problem.
Well, this was episode number 7 for Finance Unspun. We did go around 40 minutes today, Lee, but I think we covered a lot of interesting stuff. If gold and silver have not bottomed, I think we're very, very close. There's a lot of positive tailwinds, I would say, to gold and silver with the massive spike in Chinese demand. So if that trend continues, very, very good sign that gold and silver have bottomed for private sector Chinese demand. The other one is central bank purchases. The net tonnage increases have started picking up again in June and July. If we start to see those trends increase, even with the dollar relatively strong to other, and all these fiat currencies are garbage, even if the dollar stays relatively strong, we could still see gold and silver have big, big rallies as part of a fear or safe haven trade because of all the uncertainty about what these central banks are doing. And I think there's a lot of shenanigans going on with governments and central banks. It's just gone to a new level, especially here in the United States. Theater of the absurd, kabuki theater, lies and economic propaganda.
No doubt about it. Well, Jason, it's been a fascinating discussion as always, and I look forward to our next one.